a beginner's guide on how to invest in the stock market. Let's say you have $1,000 saved up and you want to do something with it. Because you want to make the $1,000 more valuable than just spending on buying another shoes or watch that you already have. And you want to enter the world of investing. But you ask yourself, where should I start? What is the stock market? What stock should I buy? Well, you're not alone. For those who click on this video, you are in the right place. Step 1. Starting an account. Before I show you the guide for stock investment, it is very important to understand the cost behind stock trading. That means buying stocks doesn't mean you can profit from it right away. With different kinds of investment accounts, there are also a difference in fees. It is crucial to determine what is your financial goal and investment objective. If you simply want to invest for a rainy day or for a certain relatively near-term goal, and don't necessarily want your money tied up until you retire, a traditional brokerage account is the way to go. These accounts don't have tax advantages. You may have to pay tax on investment profits and dividends, but you are free to withdraw your money whenever you like. On the other hand, if your goal is to save money for retirement, an IRA is the best bet. Traditional IRAs can get you tax deductions when you contribute to them, but you won't be able to use your money until you're 59 and a half. Number 2. Choosing a broker. If you want to pick your own stocks or index funds, you need to have a brokerage account. A broker I recommend is Interactive Brokers. The platform is meant for professionals, so you'll need to do some education on how to use the platform. But other than that, the platform offers low fees, many options in stocks and index funds, plus they are available in a lot of countries. Step number 3. The cost of stock trading. If you choose a low-cost stockbroker like Interactive Brokers, a single trade will cost you $1, whereas other brokers would charge you $5 to $10 per trade. If you would go for a mutual fund charges a fee called an expense ratio. The fee is an ongoing percentage charged based on the amount the individual has invested. You'll see mutual fund prospective reports that show something like expenses of 0.21% or expense ratio of 0.75%. This means that for every single dollar you invest into the fund on an annual basis, the fund takes that percentage from your account. If you invested $10,000 in a fund with an expense ratio of 0.50%, you would pay $50 per year in expense ratio costs. If your balance the following year was $20,000, you would pay $100, and so on. Expense ratios range from as low as 0.15% to more than 1.5%. If you want someone to manage your portfolio, there will be management charges for the broker's service and of course the taxes. Make sure you understand all the costs behind before you start investing. Number 4 is, what kind of stocks are there in the stock market? Number 1 is individual stocks of a company. Number 2 is a mutual fund, and number 3 is an index fund. Individual stocks are shares from a listed company. Owning a single stock would carry more risk than investing in a mutual fund or an index fund. This type of risk is known as unsystematic risk. Unsystematic risk is a risk that can be diversified against. For example, by owning just one stock, you will be carrying company risk that may not apply to other companies in the same sector of the market. So you diversify your risk by buying multiple individual stocks. So, what is an actively managed mutual fund? An actively managed mutual fund has a team of investment professionals running the fund behind the scenes. This team works daily to make money for the fund. If the fund grows larger and does well for the clients, they stand to make more money based on the expense ratio the investors pay, and the likelihood that new investors will be drawn to growing fund. So, what is an index fund? An index fund, also known as a passively managed fund, attempts to replicate the performance of a specific index. The investment team for an index fund is usually smaller than that of an active mutual fund because less strategizing is required. Index fund managers don't have to decide which is the next hot stock or growth opportunity. The index fund has a method for investing in an attempt to match the index it tracks. Any money invested in the fund is pushed through this method. An S&P 500 index fund, for example, might invest in every stock of the S&P 500 in an equal amount so that every dollar goes in 1 to 500 increments across all the stocks. When the fund receives new investment, it just follows that method and pushes the money to the market in 1 to 500 increments. Mutual funds and index funds offer diversification, convenience, and lower costs. Once you educated yourself with different kinds of stocks, The next step is to understand how do you make your profit. There are two possible ways you can make a profit in the stock market. One is dividend yield and two is capital gains. Most of the companies that pay a dividend are stable companies who are making a profit, and from the profit they pay a certain amount to the stockholders in the form of a dividend. For example, few companies that pay a dividend are Coca-Cola, Intel, Lowe's, and Walmart. The other way to make money in the stock market is through capital gains. When you buy a stock at a bargain price and the stock is going up in price during a bull run and afterwards you sell it, then you made a profit with capital gains. So, how do you do research for a stock and the performance? There are two ways to do a research on a stock, and those two methods are: number one is fundamental analysis, which is the study of the company's financials, the economic environment, and analysis of the competition. Number two is technical analysis. Technical analysis assumes that all information is estimated in the price. So basically you analyze the chart with indicators to predict future prices. Fundamental analysis is more suitable for long-term investors and technical analysis is more preferred by short-term traders. If you need free information about stocks which you can use to do fundamental or technical analysis, you can check out Yahoo Finance or investing.com. So how do you evaluate the stock which is worth owning? You can check for stocks with the following criteria. The first one is stocks that possess a long-established history of sustained or increasing profitability through an entire business cycle, which includes at least one recession. Or stocks that have a shareholder-friendly management and board of directors willing to return excess capital to owners through ever-increasing dividends and share repurchases. A share repurchase program is when a company buys back its own stock, reducing the total shares outstanding. This means future profits and losses are divided among fewer shares. Another criteria you can use is that stocks have a high return on tangible capital, meaning it doesn't take a lot of investment in property, plants, or equipment, or large amounts of restricted working capital to generate the dollar of earnings. The next criteria could be stocks that have some sort of significant competitive advantage that makes it difficult for competitors to unseat the enterprise. And the last criteria you could use is stocks that are trading at a low price to earning ratios. So what's considered low? A price per earning ratio below 16 is often a good buy. So once you have conducted all the research and educate yourself enough, you can experience the market with a stock market simulator like Wall Street Survivor, Ninja Trader Free Trading Simulator, or Market Watch, or Stock Trainer. Those are completely risk-free software and where you can gain the practice before you actually start investing your own money. Okay guys, that's the end of today's video, so I hope you guys learned something from it. Let me know in the comments below if you are already a stock investor or want to start. Make sure to like this video and subscribe to our channel for more financial education like this. Don't forget to check out our Instagrams to join our financial education journey.